Hello friends, welcome to the first lecture of the option basic section. In this lecture, we will cover what is an option. We will understand option with a real life example. We will see what is the anatomy of the option contract, what are the nuts and bolts of different option contracts, and we will see option contract from a buyer's and seller's perspective because it's very different from buyer's perspective and seller's perspective. So let's do it. So first thing first, what is an option? An option is a contract between buyer and seller of an option. So every option contract will have a buyer and a seller. You don't have to buy or sell anything actually at the time of entering into a contract. At the time of entry, when you enter in the contract, it is just a promise and commitment for a later date. So, for example, today you're opening a contract, right? You're not buying or selling anything today. You're just entering into a contract that you will buy or sell something on a particular date, which will be in future. So let's try to understand with the help of example. So this is Jack and this is Tia, right? Tia is the owner of a house which is in a particular area, and the current market price of the house is around, let's say, 70k. The area in which the house is, there is a big news expected in next 2 months, right? So there is a Central Park is about to pass and the decision is pending from local authority, which is expected to come in 2 months time. So if that decision comes in favor of the area, means the authority says that we want to go ahead with the Central Park in that area, then the expectation is that house price will be around 100k, maybe 120. But if decision comes against the area, the house price will be same. So that's the situation. Jack is a property investor, right? Tia is a homeowner. Now Jack knows all that story. So Jack want to buy a house from Tia for 100k, but only after 3 months when the decision has been made. And Jack want to hold the house for next 3 months. But Tia is concerned that Jack might not come back after 3 months, right? And she can have all 3 months wasted. There's nothing in the deal for Tia. And Jack understands that point. So what Jack proposes, Jack says that, okay, I will pay you a fee of 5,000 today for holding and commitment. He agrees that if he doesn't come back after 3 months, Tia can keep that fee and walk away. But Tia will be obliged to sell the house at 100k even if the market price at that time is higher than 100k, right, after 3 months. If we try to understand this example in the real life option terms, this 5,000 fee which Jack is paying today is called premium. What the current market price at that time will be, after 3 months that price will be spot price. Spot price means current market price. In this example, the 100k is the strike. So even if the current market price at the time of entering the contract is around 70k, but because the contract figure is 100k, Jack gonna buy this house for 100k, right? So that is called strike price. And Jack gonna buy this house after 3 months, right? That is called expiry. So expiry is 3 months in this case. And this is called a call option. Jack is the buyer of call option and Tia is the seller of call option. So what is the interest of buyer and seller in this deal, right? Buyer, if you see, Jack in this case is controlling the whole asset just by paying a small premium, which is 5,000 in our case, right? And what I mean by controlling, in this case, if price goes higher after 3 months, Jack will come back. Let's say price goes to 120, right? Or price goes to 110, right? So in that case, Jack can come back and exercise his option. So this is called exercising the option. If he come back and continue with the deal, that will be called exercising of the option. So by paying a small premium of 5,000, he is now controlling the whole asset. If it goes in favor, then he'll come and exercise. And if the price doesn't go in favor, he will lose maximum 5,000, right? So Jack is playing a safe game in this case. His maximum loss is 5,000. And when that maximum loss will happen, if after 3 months the decision of the local authority comes against the area and price doesn't go up. Price remains at 70k, right, which is currently the price is. So in that case, Jack have no point to come back and buy the house 100k, right? So he will simply walk away, which is the part of the agreement that he can walk away. He has right in this case. He has right to come back, but he doesn't have any obligation, right? Buyer has option to proceed or just walk away, as we discussed, right? From seller's perspective, it's exactly opposite. Seller is getting a premium upfront, right? Seller is getting a premium of 5,000 in this case, and seller has secured a price of the asset and the premium, right? So one important point to keep in the mind here is that whatever the premium is paid by buyer, it is always to keep for seller, no matter what, right? So in this case, if Jack comes back after 3 months and he want to proceed with the deal, he need to pay 100k on top of this 5,000. So 5,000 he already paid, right? And he will pay 100k more. So total he will pay 105k if that deal happens, and that's what Tia will receive. Out of this 105k, Tia already received 5k, right? So whether deal happen or not, in every case that 5k will be for Tia. So from buyer's perspective, a call option is a contract that gives buyers a right but not an obligation to buy a underlying asset on a certain strike price, which is 100k in our case, by the certain date, which is like 3 months in our case. Put option, if we see, we'll look into more detail of the put option, but just from the understanding perspective, put option is just opposite to the call option, right? So put option is right to sell and call option is right to buy. But the example we took was the call option example. So buyer can choose to exercise on or before expiry, right? So in this case, it doesn't mean that if Jack want to proceed with the deal, it doesn't mean that he has to come back after 3 months only, right? He can come next day, he can come next week, he can come next month. So Jack can come anytime on or before expiry of the contract and proceed with the deal, and Tia has nothing but the obligation to proceed with that. And buyer pays a premium upfront always, like in this case, Jack has paid 5,000. So from seller's perspective, a call option is a contract that gives seller a obligation to sell, but not the right. In this case, Tia has obligation if Jack's come back and she has to follow. Put option is again opposite to that. Put option gives seller obligation to buy. So seller always have obligation, if you see. So in the case of call, seller has obligation to sell, and in the case of put selling, seller has the obligation to buy, right? Seller can be assigned on or before expiry if buyer choose to exercise. As we saw earlier, that Jack can come back anytime, and if Jack comes back, Tia has to proceed, right? So if Jack comes back, that will call exercise, and if Tia has to sell house, that will be called assigned in terms of options. So Jack has right to exercise and Tia can be assigned, and seller receives a premium upfront. Like in this case, Tia has received a premium of 5,000. So just to conclude, buyer of call option has right to buy, seller of the call option has obligation to sell, buyer pays premium, seller receives premium, and buyer can exercise on or before expiry, and seller can be assigned on or before expiry. So that's what I wanted to cover in this lecture. In next lecture, we'll focus on put option. So I'll see you in the next lecture. Thank you very much.